Boom and crash multiple time frame analysis. One of the most powerful strategy you can ever learn as a trader is knowing how to do multiple time frame analysis, because it works virtually for any type of market, whether in forex, whether in synthetic indices, whether trading metals and all of that. In today's video, I'm going to share with you one of the most powerful strategy, which is a multiple time frame analysis, and you are going to get blessed. Stick to the end and you're not going to regret doing so. Sometimes when you place a trade and you see the trade moves a little in your favor, and all of a sudden you see it changes direction, it doesn't change direction just by itself. Sometimes it's because of a force coming in. This force could either be a news event, like in the case of currency pairs in forex, or a demand and a supply zone, as well as diagonal demand and support, which is determined by drawing the trend lines. So when you do your multiple time frame analysis, it is easier to know exactly where price will be moving and where price will be turning. Sometimes traders get caught because they place their trades, they do analysis just on a single time frame, and they don't know what's going on different time frames. A trader trading in the 30 minutes, for instance, not knowing what is in the H1 time frame is dangerous. So in this video, I'm going to show you how to do multiple time frame analysis no matter what time frame in which you trade in. Hello traders, welcome back to my YouTube channel. This is Kingsley from Forex Trading with Kingsley. In today's video, I'm going to be sharing with you a very powerful multiple time frame strategy that you can use in any market. You start from the bigger time frames. All right, you start from a bigger time frame. In the daily time frame, we identify all diagonal support and resistance, as well as horizontal support and resistance. So when we talk about diagonal support and resistance, we are referring to this kind of support and resistance we identify through the use of trend lines. So you go to your toolbox, you pick up your trend line, you identify all of these zones, and you try to connect them. So when you connect the wicks, you connect it for the support and you connect for the resistance. All right, this is the support and this is the trend line for the resistance. All right, so you make sure that you identify the horizontal support. Like here in this situation, you can see that price has reacted here. Price reacts in a particular zone more than twice, it becomes a demand or a supply zone, or it becomes a support and a resistance zone. So here you can see price got rejected here, it got rejected here, it got rejected here. So we plot it out. After doing our trend line, we identify these zones and we plot it out. These are the basis of taking our trades. So we come here, you can see that, and now identify that there has been another diagonal resistance up here. You can see how price was reacting to this zone. All right, so I connected it. Down here you can see it's the same scenario, I connected it. So you see this was a more like a channel. Now after you have done that, you drop to smaller time frames, the H4, and you equally identify all the possible zones. So here you see that I use this because this zone is price has been rejected here a couple of times. You can see when it came, it got rejected before it broke, and then it came, and then after the zone, which was initially a support, now became a resistance because price broke through and it came now. So you see here that up here now we connect this zone, we connect it to this one, and you see how price has reacted to it. So we identify all of these zones, we connect them. After we identify all of these zones and connect them, we now drop to smaller time frames. Remember, you are not just connecting the trend lines, you are equally identifying those horizontal support and resistance zone where price has reacted more than once, because there will be a time where those demands and supply zones will play out. All right, that will help you time which you might not be expecting. So when you connect them, it helps you to take your trades based on that. Now this is a zone. See, price has been rejected here a couple of times. You see this is another zone here. So you see that it has coincided here. So you just sketch out the zones and then you wait. Now you drop to smaller time frame. We are in the H4 now. You drop to the H1. We equally identify the zones that are here. You see that I've equally drawn out this one and I've connected these wicks. So these were the peaks that are connected. All right, and down here I've connected the troughs. So you can realize that price has been reacting to this. Now we are equally going to connect this one like this. So these trend lines could be very powerful tools in doing multiple time frame analysis. When you connect it, you connect the zones. You now wait for your price to play out. See that I have used this rectangle here, connect this support zone, so you can realize that price has been reacting to this support zone a couple of times. Now you see price moving here, which is more like in a channel, or let's say a pattern. You can see now there's there's a possibility of price moving from here or maybe reacting to this zone and heading right up to here. So what is the essence of this multiple time frame analysis? Now you can see that this is this big zone that we identified in a daily time frame. You can see the big zone here. We see clearly that price was in a downtrend. From the H4 time frame, you can see clearly that price was in a downtrend. All right, so people knew that, okay, this, you had neglected the fact that there's a zone down here. Now, for someone who did a multiple time frame analysis, would have been aware that this is a very strong demand zone because it has been drawn from the daily time frame, and support and resistance zones that are drawn from bigger time frames are stronger than those in smaller time frames. For instance, this is a trend line drawn from the H4 time frame, and price comes down and react to the H1 time frame and start going up. When it reaches the H4 time frame, it is a high probability, 70%, that price is going to get rejected at this trend line and even move right down, even break all of these trend lines, because it is a trend line drawn from a higher time frame. We already know that here is a strong demand zone here. So we are entering a trade. We will hardly be placing our TP below this zone because we have already seen in the higher time frame. Now we equally know here that this is the H4 time frame trend line that we have drawn. If you click on it here, it's going to show you up here. You are going to see that this is an H4 trend line. All right, so these zones, they might not look important for you because price has not yet gotten around the zone, but when price will move and get close to these areas, these are trend lines that we have marked out, you are going to see how important they are, because the price is going to react to those zones. You see the reasons why multiple time frame analysis is necessary. For instance, if you take a trade now based, let's say price move and then break through this zone and then comes back and retest and it's heading up, someone who just take a buy trade blindly here and did not do multiple time frame analysis will not see this trend line. This is a daily time trend line, but when price moves from here to here, when it reaches here, it's going to reverse. It could reverse and go right down. But for someone who did not do multiple time frame analysis will not know that they have to place their take profits below this zone here. All right, so that is the expectation, and you can take your trades even in smaller time frames based on trend line drawn on higher time frame or support and resistance zones drawn on higher time frame. So with this information now, you can even take your, for those who are doing swing trading, you can be doing your swing trading. All right, okay, now look at these zones that we had identified, we have drawn in higher time frame. Price could move and break through the zones. Like this is the H4 trend line that was drawn here. You can see here, you see that when price came down, it got rejected. Right, when price came down, it got rejected around the zone, and what happened, it reversed back, came back and break the zone, and then now it came back now and retested. For someone now who drew this trend line, and when you take your trades the the H1 time frame, you are going to know now that this is price has reacted like this because of this trend line that was drawn. But if you had concentrated just in the H1 time frame, you will not know that there's a diagonal support around here. So you see now that from a H1 time frame, you can take a very good trade setup here. As price retests, you enter here, you place your stop loss. You see how there was massive movement. You can see how price moved massively right until it reached the strong demand zone. All right, so you see how important it is to do multiple time frame analysis. So that is how it is. Okay, now you see that here happen to take our order here. Now I will not be neglecting this zone because when price reach here, it's going to get rejected, and that was the case here. You can see for someone who took a buy order, for instance, here without drawing this trend line here, might not have gotten a TP hit, because maybe they'll go and be targeting this demand, this supply zone up here, which might not be realistic. So you see how important it is. So let's take a recap. We started by saying we want to do analysis on doing multiple time frame. You go to higher time frame and you identify all the possible diagonal support and resistance, or the possible uh, uh, horizontal support and resistance zone, and then you plot them out, you draw them out. You go to smaller time frames. As you drop down, you identify the possible zones and you sketch them out. You drop down to smaller time frame, you identify all the zones, and then you sketch them out. Even if you trade in the 30 minutes time frame or the 15 minutes time frame and you do this, you see it's going to be very important for you, because you are going to take your trade decisions based on that. Your stop losses, your take profits will also be determined by that, and that will be very important. You can get very good setups even from smaller time frame if you do multiple time frame analysis. Like I said in the beginning, this works for any market, especially for trending markets. You can be able to do this multiple time frame analysis and you get very good trade setups. All right, so just from looking at it, you just look at it, you can just identify trade setups from the way you see price play out, how it gets rejected, and then it finally breaks, it comes back a retest. You see it gives you an entry opportunity. It goes to a support zone or a resistance zone. You see the reaction, it breaks, you see it comes at retest. You see you can take a trade even from a smaller time frame, even if that was a support and resistance zone that was drawn in a higher time frame. So that is how necessary it is, guys. Thank you for watching. Please, if you are new to this channel, just click on that subscribe button, click on the like button, click on the notification bell, so that whenever we post any video, you are going to get notified. Click on the thumbs up button if you love this content. Please share this video. We'll see you in the next video.